Before I start, let me ask you, why do you think Tesla share price is valued so highly by investors? Tesla have a trailing 12 months PE of 305. Also, why do you think Snowflake can fetch 112% increase in its valuation on its first day of IPO? Snowflake has a trailing 12 months PS of 31.2, whereas Amazon only has trailing 12 months PS of 4.6. So, obviously both Tesla and Snowflake are not valued based on their sales or financial performance. So, why are they worth so much in the eyes of investors? My opinion is that traditional metrics do not capture the vision of the company. Traditional metrics are derived with the mindset that cash is king. Therefore, I think that there is a need to change our mindset to cater to the modern style of investing. And the core mindset for modern style investing is data is king. If you apply this to Tesla, all the sensors in Tesla cars is helping Elon Musk to build autonomous driving technology, which will create a new business opportunity for Tesla, which are not captured in traditional metrics. Snowflake, a provider of cloud-based data storage and analytics service, it is constantly gathering data and turning the data into valuable insights for businesses. The data it collects, it will eventually turn into cash for the business if Snowflake is able to monetize it. This is why I'm looking at this stock, which I'm about to share in a while, which I believe will potentially enjoy significant growth if they are able to monetize their data. Hi guys, my name is Ethan and welcome to my investing channel. The company that I'm talking about today is Viva System, ticker symbol VEEV. Viva Systems is a cloud-based software company that serves life science industry, an industry that makes medicines. Viva helps drug companies to capture critical clinical data and make sure compliance to regulation. They also help salespersons for drug companies to be more effective. Life sciences industries always looking to improve their testing efficiency as well as quality. They are continuously testing new medicine and going through multiple cycles of trials and getting approval from regulators so they could market their new medicines to the healthcare providers, for example, doctors and pharmacies. They need to ensure their salespeople visit the healthcare providers and download the correct information to the healthcare providers so that the patients can get the right medicines. This is the commercial side of things for life science industry. You can imagine that COVID-19 have sort of disrupted the way how the industry work because of all the face-to-face meeting no longer viable. So this is where Viva Systems help by transforming all the face-to-face meeting to virtual meetings. Data are stored in cloud and accessible real-time by all the stakeholders. For commercial side of things, the teaching to the doctors by the salesperson is through Viva Engage, a software developed by Viva, and this system connects the salesperson and healthcare providers remotely in compliant way. The CEO Peter Gassner said that the customer relationship management platform has been made free in the research and development of medical solutions for coronavirus. This is a clever way to get its client on board onto their system. Try out their system user interface. And when you are providing a helping hand during the difficult time, you are likely to get the support of the people. This we can sort of link it to Zoom when the pandemic first hit us in March. And Zoom was such a huge hit, right? Now, Zoom started to charge and everyone is more inclined to pay since they are already using the platform. Similarly, Viva has done the same and their platform is free until September. They have seen usage of the Viva Engage increase by tenfold during the pandemic. So if they are really starting to charge the customers, I believe there should be a substantial jump in their revenue. Viva Systems also recently in May 2020 announced a new product called MyViva. MyViva enables patient-centric clinic trials. What it means is that MyViva transforms traditional clinical trials to online through their cloud-based systems. For example, virtual visits, patient adherence, ePro, eConsent, eSource, basically all the forms fillings are done online, as well as an easy-to-use patient portal, so both patients and sponsors can go through the trial with ease. Honestly, I like something like this, especially in this era. who still uses paper forms, right? I come from a big bank and we still use form fillings for account openings and system onboarding, which is a huge hassle, especially given the current situation. Banks still practice physical citing of signed documents for corporates. It is not easy for banks to change as it is too bureaucratic, and the financial industry is highly regulated. Same situation can be applicable to huge life sciences companies where physical trials and form fillings are still a mandatory, and their risk team probably are too conservative for a change or lack the budget for IT investment into bringing everything to cloud. Expertise to do so is also another issue. So cloud innovation companies like Viva Systems will be able to capture market shares and experience substantial growth because they truly are providing value-added service by transforming the industry practice. Before COVID-19 hit us in the beginning of this year, Viva Systems have already reported 28% revenue growth from January 2019 to January 2020, and their revenue lands at $1.1 billion, which makes them the fifth software as a service company to join the $1 billion revenue club. Viva's mission is to improve and extend life by helping life sciences companies to be more effective and efficient when developing treatments and getting the right treatments to the right patients. With that, Viva has on the 17th of September announced it has formed a board committee to explore becoming a public benefit corporation. The committee will seek input from shareholders, customers, and other stakeholders on the possibility of becoming a PBC before taking any further action. A PBC is a for-profit corporation that has also adopted a public benefit purpose, and in this case, Viva, in a way, committed themselves to not only serve for their own interests, but the public interest as well. This is a good sign for investors because the company's image will drastically improve subsequent to the announcement. Besides that, this company is likely to fall under Warren Buffett's radar if you look at their financial metrics. They have substantial revenue growth of 24%. This is based on their historical 3-year revenue from 2017 onwards, and likely this year will exceed 24% as well. Not to mention the stunt that they pulled during COVID-19. 24% is an understatement. Other financial metrics such as EPS growth 92% over 5 years, ROE average over 5 years at 22.4%, and healthy balance sheet. Recently, Motley Fool also mentioned that Viva had made 33% year-on-year increase, and net income grew by 18% year-on-year based on July reported numbers. Note that Viva Systems delivered these results despite the pandemic and its impact on clinical trials worldwide. Many drug makers had to halt their studies to protect all those involved amid the rapid spread of COVID-19. Despite the headwind, Viva Systems is confident in its long-term prospects. In October 2019, the company announced its intention to reach $3 billion revenue by 2025, which would represent a significant increase from the $1.1 billion in revenue it recorded last year. Another important thing to note is that the company boasts a tremendous retention rate for its subscription service segment. They managed to record retention rate of 121%, 122%, and 121% for fiscal year 2018, 19, and 2020 respectively. My valuation model indicates the target price of 323.52, about 22% upside based on 18 September closing price of 265.9. I have assumed 22% revenue growth for the next 6 years, and I think this is also on a more conservative side. However, one issue with this evaluation which I'm skeptical is the discount rate found on my usual source website. It states 5.5%, which is unusually low. Usually the discount rate used for US company is around 10%. So if I were to use 10%, the company will be worth 70% lesser. So besides valuation model, I took the guidance from Zoom share price, where it has grown 538% since beginning of this year, whilst Viva Systems has only grown about 85%, while both offer similar solutions, except Viva is specialized in life science industry. There is a company which offers cloud-based solutions for CRM, and the company is also performing similarly well, except that its EBIT margin is rather low. The company I'm talking about is Salesforce, which have seen their share price increase by 70% since beginning of this year. So for a much better EBIT margin, an additional 10% growth in share price over Salesforce's share price don't quite add up to me. Now, what entry price should I be looking at? I generally use technical charting to time my entry price. Looking at recent trend, I feel the strong support level is at 250.6, which is a downside of 6%. Another further support level will be at 240.6, a downside of 10%. The average volume is around 110 million and have been trading for more than 110 million for the past 2 trading days. So, depending on the overall market, it may go up to 270 or near 280 level or drop to 250 level. Either way, not a big deal for me since I'm going for long term. I like this share from both financial as well as product offering point of view. I think Viva system will continue to be relevant to the industry for at least 10 years to come. With the CRM data that they collect from Viva Engage as well as My Viva, I hope Viva Systems is able to monetize the data in the future. My ideal entry price will be around 240. Currently, the market is expecting vaccine to be made available around mid-2021, but I think they may be made available in Q1 of 2021, which is earlier than expected. So most likely this will act as a catalyst for the stock price to go higher up. Depending on how the stock performs towards year end, I may enter if it is still hovering around 240 to 260 level. I won't be going in huge, however. Usually I will only allocate below 5% of my total portfolio in high risk stock. Although it is a high risk stock, I personally think that anyone below the age of 40 should have at least some high growth stocks in their portfolio. Having said that, however, one should not take them for granted. Continuous effort in monitoring the financial performance as well as the business development is essential. Never slack. After all, the result is a consequence of your action. No one will take your gains from you and no one will pay for your losses. So treat your money with prudence and care. Anyways, if you are interested in my progress or if you would want a further update on this company, or if you like high growth series like this, please subscribe, thumbs up and comment. With that, I shall conclude my video here. Thank you and bye bye.